Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, October 23rd, 2023. Markets are now closed, so what I'm going to do is an update briefly on the equity markets, the market leading Magnificent Seven stocks, and then my things to watch list. That's a watch list I started covering a few months back of just an eclectic mix of several companies and or asset classes that I think are important to watch right now and could give us some tells on where the market and the economy are headed. All right, starting out here, I'm on the homepage. I just wanted to show you, especially for those of you new, to utilize this section here under resources. You click at the top menu there, down tools of the trade, and go to earnings calendar. All right, we are now in what I call peak earnings week. I don't know what the everyone's going to have their own version, but to me this is by far the most important week, really concluding with Apple next Thursday. And so when you come into the earnings calendar here, what you'll look at is the company's reporting. I'm going to zoom in a little so you can see it nice and clear. That's going to take you in today. If you went in this morning, it would show you the companies are reported before the market opened. So now this is after the bell here. You can see who's reporting, what the expectations are. I'm just going to click forward. I'm not going to do them all. I'm just going to highlight the big ones coming up. So really nothing. This is tomorrow morning right here, Tuesday before the open. Coke, Verizon, GE. That's one I mentioned as a short trade idea recently. I'll try to remember to get to that. I didn't plan it in this video, but maybe I'll get to that one as well. Okay, so really starts out here tomorrow after the market closes. You have a couple of the market leading Magnificent Seven stocks. You, of course, have Microsoft and Alphabet. Those are your two share classes there, as well as Visa. That's also an active trade idea right now. You scroll down, one of the big semis is there, Texas Instruments. So really, this is peak earnings week because you have the majority of the market leading stocks, the ones that have the biggest impact on the market, both from a mathematical weighting due to their market cap. They're the biggest components of the S&P 500 and the NASDAQ 100. And then, of course, the psychological significance. And so I just wanted to take a look at that. And also, know what when you're heading into earnings season, or really at any point in time, because some companies report, kind of randomly, not so much in earnings season. And then you have your cluster, the big banks report around one time. They really kicked it off already. They're out of the way. Then you get the regionals reporting around the same cluster of time. Big tech, as you can see here. So the thing is, know when your positions or any trades that you're thinking about taking report. Because what you don't want to do is take a breakout on a stock. Let's say you go long, a stock you've been following breaks out of a bullish chart pattern. You go long that day, and then that night they report, and it's a bad report, and the stock gaps down 10% the next day, blows right past your stop. That's why you should have an idea of what's reporting when they report. And as I always say, every earnings season, I like to remind you that all stocks aren't created equal when it comes to earnings. Some stocks have a history of large gaps towards or against or in either direction. Netflix being one of them, even some big large cap stocks, mega cap stocks. But typically the smaller the stock is, the more volatile it is. And also there's just a component there, as I often say, that some companies do a much better job of managing earnings expectations and giving guidance. And so there's not as many surprises. But with that being said, it is always certainly an increased elevated risk of a large gap that could go for or against your position when a stock reports. So know when they report and then manage it accordingly. What does that mean? Well, if you're risk averse, you're not doing what we're doing here. So go buy a 5.5% CD at the bank right now or money market, and you should be happy. And we finally have good short-term rates. However, what I'm being a little facetious there, we're all, some of us more or less risk averse on our trades and trading individual stocks, what type of stocks we own, what kind of losses we're willing to tolerate to chase, X amount in gains. It's all about risk reward ratio. But where I'm going with that is, if you are somewhat risk adverse, then you might want to close a position out in front of earnings or reduce it, or maybe even take a hedge against it. I say this, that usually if the charts are clearly bullish or bearish, heading into earnings on a stock, that's the way it's going to go. Not always, but often. So just want to throw that little side thing out there. So there's Visa. Again, we have Visa coming up, Texas Instruments. That was Tuesday after the market closes. Wednesday morning, Boeing is always a potential market mover, big industrial. This is Wednesday now, Meta, IBM, KLAC. That's a big chip equipment maker. So that for those of you trading short currently or long in the semis, SOXX or any of the semiconductor stocks, particularly the chip equipment makers. And they tend to be the canary in the coal mine for the chip sector because they make the equipment that semiconductor companies use to make the semiconductor chips, right? So it only makes sense when orders start tapering off or picking up for the chip equipment makers. That's often a sign that things have turned or picking up or going the other way in the chip industry, chip sector. All right, that's through Wednesday, then Thursday. UPS is a biggie. You can see here. Again, do this yourself. I'm not going to go over all of them, but the big earnings this week conclude really on Thursday here after the close with Amazon. Intel doesn't carry the weight that it used to for the chip sector. It used to be the 800-pound gorilla. It has long since lost its title to several others, but not including the big one, of course, being NVIDIA. All right, there it is. So that's what we have this week, and then you have to go ahead and then Friday, if you're in the energy sector, remember that certain ETFs like XLE, the energy sector ETF, and even XOP, they are mostly made up. I haven't checked lately, but it's always been over a 50% weighting just between these two alone, ExxonMobil and Chevron. So know that if you are trading energy stocks, that there's some big energy companies reporting on Friday morning, and then that's it. Usually you don't get much on like one company reporting after the close on Friday. And then you go to next week. I'm just going to fast forward. Again, you can do this yourself. There's quite a few big companies reporting, but the conclusion comes Thursday after the close with the big one. And this is the king of all stocks, largest component of the S&P, largest component of the NASDAQ, and that is Apple. And they're going to really, to me, that kind of concludes, if you will, peak earnings season. And there's kind of that lull in between there. Remember, so it's going to be this Thursday, and then up until it's a full week before any big market moving techs report. So I think we'll have a good idea, guys, by this Thursday, which way this market wants to go. And I'm going to dive into the charts here in a second. There's Carvana, one that I've highlighted and been short recently. They're also reporting next Thursday as well. So that's that. Let's take a look at the charts. Okay, and of course, remember, the takeaway is earnings week is one of the most, especially peak earnings with these particular companies, one of the most volatile times you can have. The VIX has already been elevated. And again, I think this earnings week has a very good chance to either give me an additional check marks for the bearish case, the fact that this market peaked in July, that was the end of a bear market rally. Again, the theory I'm working off of, and that we're going a whole lot lower in the coming weeks to months and possibly even years. Okay, or likewise, depending on how this next week goes, it could increase the odds that we're going to see that marginal new high scenario that I still have not been able to eliminate. So let's talk on that. So for weeks, if not months now, I've listed this as my alternative and what I still consider a longer-term bearish scenario, that the market goes on, punches up, makes a marginal new, meaning slightly, relatively, whatever, 1, 3, 5%, not much more than that above the previous highs. And to do so would extend these negative divergences that are already in place. So if the market likes what the big fangs and Magnificent Seven are selling over the next week or two, then that the odds are going to go up. And when will they go up? Well, again, it's going to be incrementally. Like I showed you, some of these earnings come in clusters with one or two big companies reporting at the same time this week. And from a technical perspective, the levels you want to watch, I know this chart's gotten a little bit busy. I have the red level here I've been highlighting for months now. and we already hit it. That was T1. We hit it there. We bounced. We've been testing again today. And then in some of the recent updates, I told you that the fact that we already undercut it, this was, it was and still is a level on the daily chart. I always say this when you're trading using technical analysis. At least this is me. This is my style, what I've learned and evolved to. All that matters, or the most important thing that is how the candle finalizes on the time frame you're trading. In other words, if I'm trading a 5-minute chart and I'm looking for a trend line breakout, I might take the breakout initially on the trend line, then it's solidified if I get a solid 5-minute candlestick close that prints above there, and then I may add to that position, or it's just going to increase the odds of breakout. It's going to stick. If it falls back, it's a whipsaw. So, and then I always say that traders always focus on these reaction lows, and I'm talking back here, if you see all the way back from September 27th, that's a reaction low. So that's what we hit today. So there's a lot on this chart. So number one, and I've said it before, once you establish that reaction low, that really becomes the support. But again, there have been so many reactions here, and again on this daily chart, we closed there on Friday, and then today we had an intra-period break under, but this green candle tells me that we closed back above it. So we closed at 355.67. So that is not a sell signal. And also, if it did happen to close below there today, even if it happened to take out this low, you would have to, unfortunately, take it with a grain of salt. Now, you can take it on face value and add to shorts if that's your thing, or if you didn't have any. But with earnings, peak earnings week, just like a breakout in the market or treasury bonds or something that happens right before a big market moving FOMC announcement, you have a higher chance of a whipsaw this week. So once Thursday's out of the way, then boom, the markets are free to do what they want. You'll have the majority of those Mag 7 stocks already reporting, just Apple to go next week. And again, over the next day or so, trading session Friday and into Monday, the market will most likely pick its direction. In other words, it's either going to break down and start moving down, run at the 200-day moving averages, and the next targets that I have, T2 is, by the way, T2 is, oops, that's that previous reaction low. T2 is right there, T3 is there. And so that's it. The takeaway is, you can't force it. My views. I still maintain and have not waffled once that this is still just an alternative scenario. To me, I've said this before, I don't view it as wishy-washy. If we get it, it's just near-term bullish, but longer-term bearish. I've not, changed. Nothing has changed. If anything, I've only solidified my outlook for the long-term bearish scenario due to a lot of the check marks that I've highlighted in recent weeks with some of the key things that I was watching. However, this is a big one. So we haven't taken out 354.70 yet, especially on a daily closing basis. So that's that. What we did do, of course, last week, and that, like I said a week ago, you can, if you want, I think it's objective to be in a short the rally mode. Somebody asked today, hey, was this rally today? And I was right at the highs when I got to that question. Yeah, I think it's objective to add. I said the same thing. Be aware that it's earnings week, so maybe don't go in so heavy if that's your thing. But basically, you can see we had a perfect back test of that symmetrical triangle that I highlighted last week that we broke down below on Friday. And so it's a breakdown back test. Now, think about back testing, you may back test again. But what starts to change the technicals? What starts to subtract some of those recent check marks that I had for the bearish case? Well, a solid pop back into the triangle, and especially a pop above it. That's going to increase the odds of this marginal new and divergent high scenario. And like I said, there's no guarantee that it's only a marginal new high if we break out the new highs. Anything much more than that, and I'm just dead wrong on from this point in time. Maybe I'll adjust my views if the charts tell me when we get closer up there, but that's that. Let me show you now two more things and then we'll wrap the video up. I'm just going to go through the market leading stocks, those Mag 7, and what I've been highlighting repeatedly in recent months here are these purple levels that will kind of give me that, call it all-in moment, but just additional check marks for the bearish case. In some of these stocks, I have a single level, some I have two. They're just key support levels that I want to see taken out to increase the odds. On Apple, that's about, not hard levels, but roughly 170.37 and then 166.61. Doing so will also have taken out the 200-day moving averages. So, I'll play the glass half empty, glass half full game. Glass half empty means you're bearish. Glass half full, you're bullish. You're an optimist. Well, the glass half full game says this is Apple is testing its 200-day moving averages. This is the red line here is the exponential. We already hit it and bounced, and we got that long. I mentioned closing the short there and going long Apple and the indexes. However, we're now back at it again with the 200 simple just below there. And so, going back to what I just said, if we take out the lower level there, that 166.61, especially on a solid candle, whether it's a solid intraday, especially a daily close down below it, you're going to have taken out the 200-day moving averages, and that's bearish for Apple in many, many tech stocks. So there's Apple, still above both of the purple level. In fact, it touched today, so this bounce was no surprise at all. We hit, confluence of key support. That first purple line, which again is support, the 200-day simple moving average, we hammered right off or reversed right off it there. And so now that needs to go. And, Apple, unless the other big tech set the stage and the tone for the market, I wouldn't be surprised to just see, this stock kind of chop around in here between those levels, that I have there, the key downtrend line there and the 166 up until earnings happens. Okay, I had to pause it there and do something, and picking back up, I think I covered everything on Apple. So again, those are the levels to watch. And once again, between now and next Thursday, unless you see a huge breakout in any one direction or another, you might want to take any breakdowns with this at least somewhat of a grain of salt. Again, depending on everything else. You see market just melting down here or blasting up because, most of the big fangs. And again, on that, I was about to say most of them, beat earnings or miss expectations. That doesn't matter. That never has mattered. All that matters is the market's reaction. In fact, to take it a step further, quite often stocks will bottom on a disappointing earnings miss, only to see the stock, whether the initial reaction's down, quite often is, or immediately rallies. Likewise, many stocks, Apple being one of them. Apple peaked right back here. The last earnings here was August 3rd right there. And that came right off the top. So where I'm going, the important thing is the market's reaction, not the actual report. And like I said, to take it a step further, nothing's more bearish than beating expectation, blowout quarter, and then to see the stock sell off. I remember the analysts tripping all, or at least the guys and gals, the so-called experts on CNBC last time Apple reported there, tripping all over themselves how bullish it was, and here's the stock since in a clear downtrend. Microsoft breakout of the downtrend line, as I mentioned, was very unimpulsive. It's been back testing it since. I'm referring to this primary downtrend line off the highs. You put in like Apple, you had some positive divergence recently, and then on a shorter term time frame, you broke this uptrend line right here, like many of the stocks had, and we're below that. So it's kind of pinched between support, both the trend line off the highs and price support there at about 324. And I probably should and could color that up purple. That coincides with the purple line Apple just hit. But I'll just leave this one here. Next one's about 311, 310 on Microsoft. That's my more significant level. And just below that, remember, you have the 200 days right there. Alphabet, again, I could put another purple line here if I wanted to, but we'll just leave the one I had, 127.15. Big support level, in my opinion. And we have the minor support here, 133.63, which it hit today and had a little reflexive bounce. Amazon, I think, as I said, they report Thursday after the close this week. And you have the key levels here, about 123, and then this longer term primary uptrend line right here off the January lows right there in purple. And with that also comes in right with the 123 level is this red line, the 200-day exponential moving average. And then you have the 200 simple moving average roughly aligning with this uptrend line off the lows right there. NVIDIA, let's see, their report, their last earnings was back here, 3 months. Yeah, they're the only one that's not going to be reporting in the next week or two. So they'll probably follow the overall trend of the rest of the semis. You have quite a few semis reporting. Purple line's about 403.30, 375, and that also comes in with the primary uptrend line. So you have a whole confluence of key support levels below the 200-day exponential simple moving average. So this whole thing here, this is kind of lights out in my opinion for NVIDIA if and when that level goes. And based on the divergences, nothing changed. I do think it'll go. And just like the broad market, if it wants to run up, put in a new high, as long as it's just a marginal new high and we reverse, you're still going to have the same negative divergences that are in place. They'll just be extended. So it's still only my alternative scenario. But, well, you know, again, we'll trade the charts as they come. And that's about it. Meta, purple line I have down here. Meta, big divergent high right there. Negative divergence. You got my targets. And last but not least, Tesla. Tesla already broke down here recently. They just reported. And you had the break of the uptrend line. Remember, you have your primary downtrend line, bear market downtrend line right there off the November 2021 highs. You have this uptrend line, which was broken right here, right before earnings, post-earnings drop, and two important levels that support levels just below. So you had that smaller triangle pattern you broke to the downside. And as I often say, when you get these triangle patterns, typically the direction you break from is the establishes the next tradable trend. So far, that's clearly been a downtrend in Tesla. Okay, now on to my things to watch list, and we'll wrap this up. I sorted it today. Right now it's sorted by gainers today, so we'll just talk over that. Carvana is highlighted as a short trade here. You had a divergent high, and like so many, this is a common theme today. Had a lot of stocks right after the open today hit price targets, support levels and or targets. Some of those I just went through with the big Magnificent Seven stocks. A lot of them hit support. Even the NASDAQ hit support. You know, it took it out intraday, but then tested that previous reaction low, only to close back above the key support level on QQQ that I started the video with. And Carvana hit there. So you have all these reflexive bounces. This is where, you know, you're going to get at least a minor reaction and maybe more. You know, support is support until less broken. So the way this works, Carvana has to take out 29.80. That was hit today. And then it opens the door to these next targets you can see down here. Copper, this is a copper index, still moving lower. It used to be, they used to call it Dr. Copper because it had predictive value and saying where the economy was going. Basically, if demand for copper is falling, economic growth is falling. If you're building a lot, there's a lot of new building and infrastructure and things going up, you know, copper lines for electrical and everything else. And so anyways, you can see it's been trending lower also. Yellow flag, if you will, to the economy. Cars.com just hit that $16 price target. Remember, this one was in my things to watch list. We highlighted, first started highlighting back here. So you had sell signal 1 on the breakdown. I talked about it at the time. It was a big red candle, but there was plenty of opportunity to get in short there. Went down, hit the first target, which was this was your minor trend line. There was your more significant long-term uptrend line. Hit that bounce, then took that out. That's another sell signal. Been working its way down. We have this trend line here. It broke out of recently. It's been back testing. And it, like a lot of these, I want to point this out, a lot of these stocks have now, I'm noticing some positive divergence setting up here on this daily chart, which could lead to a bounce. Think about it in a bear market or a bear, if this is a bear market with a lot more downside to come, those divergences, they could either play out for a little bit and then get taken out, or they may not play out at all. I just want to highlight they are there. And again, little caution is warranted till we get through this earnings week, or we start to see a lot of these potential positive divergences taken out. By taken out, I mean you have to take out the previous lows then the slope of the line goes negative along with prices, and you no longer have positive aka bullish divergence. So there's cars.com at support with positive divergence. Great time to cover that short if you are in it or took it. And if you're a bull, you want to go long here with a stop somewhat below, and target. I don't have upside target. Just use the short targets in reverse right now. LQD, corporate bonds, big level here. There's the previous lows from October. That's when the stock market bottomed, October 2022. We just hit that. And I'm seeing a lot of fixed income products, throughout TLT and the long bond, the 30-year bond, and the futures. It's a long trade idea recently. So you have a pretty big green candle here coming off there. So successful test of that low right now, double bottom there. And that's a key reaction low. And so, again, this is something worth noting. And bonds have been correlated with the stock market recently, unlike in the past where they used to be inversely correlated. So, again, little cautions warranted right now. I just want to point that out. LQD at support with positive divergences. ITB, home builders, we shorted this one back here. And then again here, second, little small wedge breakdown there. Larger primary uptrend line off the October lows, breakdown, back test, T1, 2, 3 hit. The last update I gave you was the other day when we hit the top of the T4. It's a zone when I have two support levels in close proximity. I'll label that as a target zone, and you can cover the top or the bottom. It just means I could flip a coin as to which one we're going to reverse on. So as I think I said at the time, what you do there is you set it when you get down there to the top of the zone, tighten up stops, see if it can carry on down through, and you milk a little bit more. And then, so it's hit that level, and there again, odds favor a reaction. Plus you have the positive divergence as well. So this is new, guys, as I'm going through this. And again, I've marked some of these up, and I'm marking this one up in real time. I'm seeing quite a few of these things I've been bearish on and many of those short on setting up right now with positive divergences. It could indicate we're looking at more than just a little bounce here if these divergences play out, of course, and if these support levels hold. Paychecks. Watching this one, more of a tell on the jobs market along with ADP, and really not much to report here. Last time I highlighted these conditions here, the extreme overbought with the bearish PPO crossover, said that was a good shorting op as it was back here and here and here. And it sure was there. And if you took it, you made, down to there about 13%. Took out this near-term downtrend lines back testing. I don't have a strong opinion on it right now. Just, again, I'm going over this, just clicking through these in order. Fallen, this is a bond fund. These are, they were formerly investment grade bonds that recently were downgraded. I don't know what the holdings are now. The Fed came in and they bailed out the bond market when COVID hit, including this one. They were actually evoked emergency powers to buy bonds and bond funds, things they used to not, even ETFs. And I believe they bought this actual one side. I don't know what the holdings look like now, but I can tell you there's some positive divergence there, just like there was back here. And again, I don't think we're going up here if it plays out, but you can certainly see a potential target right there, that downtrend line. So you had a little divergent low there, you got that pop. So just, again, something worth noting. And again, if these divergences just get burned through, then that's quite bearish. Again, bonds are pushing, a lot of bonds are pushing multi-year lows on price, which means multi-year highs and rates. This is JNK, junk bond ETF. And again, just small little, I'm just marking them here for you. I just noticed these small little divergent lows. Sometimes that's all you get, a little small divergent lower high, and then you get a rally. JFR, I added this one recently. This is a floating rate fund. My former life as a stockbroker, financial advisor, I used to, some of the products I used to sell, normal points in time. They're relatively secure. They're senior debt, meaning they're adjustable rate loans, so that you want to have them in a rising rate environment typically. And you would think, well, Randy, rates been going up. Why is this going down? The problem is they are tend to be they're senior ranked loans, but for pretty much junk companies, companies that need to go and borrow that method. In other words, they're kind of like junk bonds, if you will, with an adjustable rate is the easiest way to tell them. So this one, I'm watching these. There's several out there, and this one just punched through. It's not far below, but it's flirting with breaking down into multi-year lows right there. And like a lot of things, however, there's some positive divergence setting up. And so, again, I'm watching this carefully. We might be able to extend the gains. That TLT and ZB did go on to break out. I'll get to that in 1 second. I'll give you that trade idea 2 days ago. Told you it was both either a pure play long on going long for bounce trade in bonds, or as a hedge to stock shorts, because if bonds rally, that means yields are dropping, and therefore the stock market will probably rally, as it did today. So it's no mere coincidence that Treasury bonds rallied today, meaning yields fell and the stock market went up. MUB, this is a national municipal bond fund, kind of the benchmark I use for muni bonds. Testing those previous October lows. This is where the stock market bottomed back in October of 2022. And we're testing that now, but we do have positive divergence. So we're really at a make it or break it time for bonds, where they need to step in here and buy it up, hold these lows, and then we could see, again, an abatement in yields, meaning bond prices rally, yields fall, and that should be a net bullish for the stock market, net bullish thing, unless it's Treasury bond yields rallying because of a market meltdown. That's the one little exception or asterisk I put in there, where you might see bond yields falling sharply or coming down pretty good, but not be bullish for the stock market. PSP, private equity, I've been calling this one, along with pension funds, as one of several big shoes to drop that I think you'll read about in going forward in the coming months to years. And certainly you see the private equity. It's this ETF that holds private equity funds, companies. I'm talking like Blackstone, KKR, and the likes. They're all in here and moving lower. And it's kind of, again, this is my things to watch list. I'm looking for potential. Where's the next crack in the financial system coming from? And Moody's, bond insurer, there it is, or rating company, I'm sorry, Moody's. Positive divergence as well, although it is, sell signal 1 breakdown, sell signal 2, break of the secondary trend line back test, and it's now below that target right there, that 377 level. And again, just because you have divergence doesn't mean it'll play out. It's something to watch for if it starts to. But if it gets taken out, a lot of these just burn through the divergence. That's going to be pretty bearish and probably just send these stocks down pretty quick to the next support levels. MA, MasterCard, this is a trade idea. It was first highlighted here along with a lot of other financials. And there's our breakdown of the wedge. You guys know this. I did an update on it the other day. S1, we hit today. S1 means first support. It's a confluence of the 382.63 price level and both the 200-day exponential and simple moving averages. So this is where, quote unquote, doing my little thing with my fingers, those little quotations, the bulls should be stepping in and buying with both fists. You have MasterCard pulling back to the 200-day moving averages. Last time was here, perfect kiss of the 200 exponential, and it rocketed from there, didn't look back. And then the time before was right here. It did 2 tests of the 200 simple, and you got that. Right before that was right here. They both came in together, the exponential and simple, the red and blue lines, and it gave you that. Okay, so this is where they should be buying, but if they don't, that's bearish. And still a short trade. We're at first support and the neckline right there above, T1, T2. And they're I think they're reporting soon. I know Amex just reported recently. ADP, another big payroll company. Sell signals back there, divergent high, breakdown. And this is a big one to watch, because if you overlay ADP with the S&P 500, go back as many years, as many decades as you want, you'll see a near perfect correlation. Why? Because obviously the job market is strong or growing. ADP is growing. They're making more money. They're processing more payrolls. Likewise, when people start to get laid off, and the thing is, you might be able to, this is in my things to watch list, because this can be a tell. Hey, it's something going on. If ADP stock starts to fall, and they are reporting soon. I think I saw them coming up in the next week or so. Specialty finance, things like Rocket Mortgage and the likes in here. Again, positive divergence, it's going to rally, now's the time to do it. Got my next target down here at 332.78, so my guess is at least it's going to come down there before any reversal. And if it breaks that, we're going to burn through the divergence. And again, that's a sector with several things in there. Like I said, specialty finance. KRE, regional banks. Okay, still ugly. Taking out support right here. Not by a lot, but not too far off those bear market lows right there when the 3 big bank failures hit earlier in the year. So obviously not a healthy sector. Credit is contracting. Interest rates, mortgage rates are closer to 7% now than they are 6% at a multi-year highs. So we know what's going on there. IAI, broker dealer index, positive divergence, potential divergence. I keep referring to this as positive divergence. Technically speaking, and I make a lot of this stuff up, to me it's called unconfirmed divergence, because to confirm it, you need to make a bullish crossover in the PPO. We don't have that yet. PPO is a momentum indicator. It's pointing lower. So it would need to turn up, put in a higher low on the PPO. So it's only potential divergence. And again, could be burned through. And I suspect it probably will, even if we get a little bounce first or not. Nothing's changing, my outlook. SOX, semiconductors, breakdown 1, backtest, break of the secondary trend line there, break of the third primary, third trend line, big support, already under my red level there. Positive divergence, so this is it, okay? If the bulls are going to do it, now's the time to do it. You have the levels to watch. You are at support, a lot of things. This is good support too, by the way, for the semis. Look at this. Reaction highs there. Reaction highs there, reaction low right there. I'm sorry, right here. I was doing the wrong level. Reaction high, breakout, big, powerful. That was that big move from NVIDIA when they ripped up there and took all the semis with it. Very technically significant level for the semis. So these are levels to watch. That's why I'm spending all the time covering all these. TPIT, trade idea. Hit 2 targets there. We're at 3 total given. We had a rally off T2, but I highlighted again recently as a new trade idea with a divergent high right there. Breakdown, and it's still working its way down below this trend line. Needs to take out 1534, and that'll open the door to 1383, 1241, and then $10. MG 132, that's copper. Copper again, breakdown, divergent high at support. Top of a support zone. Caterpillar, divergent high, big industrial, really kind of a tell on the U.S. economy or global economy for that matter. T1 hit, T2 hit, T3 hit, came close to T4. I'll still maintain these targets. I think they'll be hit. We're put in that divergent high, and it's been moving lower since. IX 1580, life insurance at support right now. Breaks that, it's going down to the next level there. That's again a sector right there. Visa, also a short trade on the site. Head and shoulders pattern, nice one in my opinion. Left shoulder, head, right shoulder, neckline, short at the right shoulder, short on the break of the trend line the other day. Or I was highlighting this all the way back here too. And these are still my targets, T1 zone, T2. PZZ, this is, I seem to be the only one talking about it. I keep looking, can't find anything online. I see a problem with California muni bonds. California is one state that I figured will have problems, including but not limited to ultimately a major failure or problem with CalPERS, the largest public pension fund in the country. This just doesn't mesh with the rest of the municipal bond market. California muni bonds have been falling off a cliff here. Broke all the supports, including the 2020 lows of COVID, including the October of 2022 lows when the stock market and all other bonds bottomed back then. Something different is going on here. It's not being talked about. Maybe it is now. If you guys find anything on it, let me know. I keep every now and then I search the internet. It's been in my things to watch list long before it made this breakdown, and the fact that it has broken down. See, there's the MUB, the National Municipal Bond Market, which is, still holding above its COVID lows, still testing the 2022 lows. And so doesn't make sense that California is melting down. It just shows you it's not specific to interest rates. That's what I'm showing you here. That's the takeaway of my read. There are two things that will make a bond go down in price. Just two. Keep it that simple. Forget about supply and demand. Just keep it simple. Interest rates, that's an immutable variable. Bonds go inversely, trade inversely to interest rates. And then the other is credit quality. So, and therefore a combination of the two. So we know that interest rates have been going up. So therefore all bonds have been falling. Treasuries, corporates, municipals. So that's normal, but they're all right here. That's one of those lows. The only thing that would make California drop that much more has something to do. Those in the know, there's something wrong. And Californians, the taxpayers, are on the hook for any shortfalls with, and again, maybe it's not CalPERS, maybe there's something else. According to all you look back this year, California's finance had a budget surplus going into the year and all this good news, but the charts are telling me something different. So, all right, let me continue on. FedEx, big tell. Again, this is another one you can overlay with the S&P 500, FedEx and UPS to kind of see what their tells. They're canary in the coal mine for the U.S. economy. If they start to drop, there's something wrong because they tend to ebb and flow with the S&P 500 due to the economic cycle. So that one's bearish looking chart. Auto and truck dealerships, there's several I have in there. AGO, one of the biggest bond insurers, and we made a point. It's been bearish. I think it's going a lot lower. This is a big level there. If it cracks 45.18, and I think at some point it will. Again, watch, for example, watch California bonds. I don't know what their exposure is there. There's one larger. They're the second largest, I believe, muni bond insurer. The largest, and I just found this out today looking into it. I didn't know this. It's a mutual insurance company that was created around 2010 after the last financial crisis. I forget the name. I had it here somewhere. Mutual insurance companies, most are stockholder companies where profits then go to the shareholders. And a mutual insurance company, I used to be with State Farm years back for a long time, auto insurance, homeowners, and they would the policyholders are the owners, and so therefore if they have a year with lower than expected claims, you actually get a dividend, you get a check back, you get money back. So there's something there with that one. It's not publicly traded, so I can't track it. So I'll watch this one. And like I said, I'm very interested to keep an eye on the municipal bond market in the coming months to years here, because it's huge. Bond market, both publicly traded bonds, corporate bonds, as well as municipal bonds, they're big. And there's a lot of them out there. And it's an integral part of the financial system, make no mistake about it. All right, XRT retail ETF. Again, this is when it peaked back in 2021. Retail ETF is testing its bear market lows. So what in God's green earth is the NASDAQ 100 and Apple and Microsoft and NVIDIA? What are they doing closer to 52-week or all-time highs than their bear market lows? If retail, again, this reflects consumer spending. Consumer spending is over 2/3 of GDP. It dwarfs government spending, anything else. Your government cannot spend their way out of a recession. If the consumer tucks in their belt, then everything's going down. And again, this is just a tell. It's something I'm watching. So watch for a break under that 54.90, and that would be a further evidence that the stock market and the economy are going lower, and it's just we're getting some mixed signals out on the economic data. JP Morgan, covered this one recently. False breakout, had a beautiful little setup there on a shorter term time frame. Divergence, popped it, but the breakout failed, as I mentioned the other day. That is out and out bearish. No other way to spin it. And remember, it came off a much larger bearish chart. I've been bearish on these. Admittedly took them long as hedges there, and then threw them my hand away. No problem, mucked it. It was up pretty nice after the breakout, but the minute that breakout failed, I'm out. And remember, that's a signature of a bear market, a beautiful looking bullish chart pattern that fails to play out because there's no buyers on the other side of the breakout. Some problems, banks are, sit here and I could do another hour-long video on fundamentals and all these metrics they're looking at now. M2 money supply, things like that, and all the consumer. I'm sorry, the corporate lending standards are really cracking down, and they're that's not good. That coupled with rising interest rates is not good. So that's that. And if J.P. Morgan can turn around and maybe this is the bear trap and then breaks out again, takes out that high, then it's got a different story. The divergence is still in place. And if it makes a new low anytime soon, maybe it's my first target down there, the short target, we still might have the divergence. So I may revisit this one on the long side again. Again, depends what happens this week and next. KMX, CarMax, again, I picked on these car dealerships. Beautiful little divergent high, bearish wedge breakdown, resistance, and this thing's dropped. And what's going on? CarMax dropped 29% and still just in meltdown mode. Probably gonna, like many stocks, probably gonna take out its previous bear market lows and continue lower. AMBC, Ambac Financial, I just updated that today. This one we shorted way back here somewhere. So hit the final target. Probably going lower. You can lower stops if you want to let it run, or just take profits and move it on to something else with more downside potential. And AutoNation, look at that. And this was a big old trading range here, right there in purple lines, broke out, and it's failing. It's not close enough to say that it's failed yet. I have the top right there, but if it goes down much lower, once you re-enter, that was a huge breakout. So this thing, if we fail and get back down into this range, odds favor you're going to go to the bottom of the range and then probably down through it, because that means if we fall back into the range, that this whole thing was a failed breakout, aka bull trap, breakout to new all-time highs. Very bearish if it fails. So, and I think there's a good chance it will, but it's in my things to watch list. Treasury yields, TNX, that's the 10-year yield, negative divergence. And there's your primary bull market uptrend line on yields. UPS just broke support here recently. It had a little, it does have, like a lot of things, some positive divergence, just like it had a little divergent low right there. See the positive divergence? And you got a little pop out of it. However, this is what a bear market does. It just sucks in long, keeps showing you these divergences. You can trade them, but what happens at some point they just stop playing out at all. And so I can tell you definitively, forget about the divergence for a second. We've now taken out that 154.90. It's good, really good support. Big support right there. Look at that. Big old massive thin zone down below it. Means a thin zone, just very few trades occurred. So what that means to me is a very good chance that this stock will, in a relatively swift manner, head on down to 123.75. So I don't know when it reports. I don't know if I went over that already, but it's about a 17% drop from where we're at. So you can short it here. Again, scrub earnings first with a stop somewhat above. Makes a very nice RR, risk-reward ratio. You're risking about 8% to make 16. Well, 2 to 1. You could use a tighter stop then, of course, because it already broke down. Keep a tighter stop on it. And that's it. CarMart. Oh, yeah, last one on my things to watch list. CarMart. What's going on with these auto dealerships. Divergent high, big resistance. I mean, this was a no-brainer short. It's just been waterfalling lately. At support now. So, do you short it here? No. This was a short here or on the breakdown there. Not now, but I do think it's going lower ultimately. Okie doke. Rather long video, but those are the things I'm watching. And as always, as this week progresses with earnings, I will give you updates. And if and when my views change, if I see something I haven't seen, I will certainly do my best to get it out to you as soon as possible. Until then, just expect some volatility this week. Nothing's changed in my longer to intermediate term outlook, or even my near term outlook, which is all bearish right now. But like I said, there are some things in the charts that if, depending on how things go this week or next, could change the near term outlook, but would not change my long or intermediate term bearish outlook, at least not anytime soon. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.